Welcome to Better System Trader, the home for systematic and algorithmic trading. Welcome to the show. We've got Rob Hanna as a special guest, and welcome, Rob.
Thanks, Andrew. It's been a while.
It has been a while, actually. I checked up. You were, actually, according to my notes here, you were here episode 7, 9 years ago. Can you believe that? May 18, 2015, 9 years ago. So it's been a while.
Yes, it's been a while, yep. You look just as good.
Oh, thank you very much. It's all the fancy lining here. So, obviously we've spoken since then. Wasn't the last time I spoke to you was 9 years ago. And the reason for the invite on the show today is that you recently won the 2024. Let me get this right. NAME Founders Award, and NAME is the National Association of Active Investment Managers. So you won the award. Congratulations. That's a great achievement. So we're going to be discussing some of your research into volatility-based trading strategies, and you're going to challenge some conventional wisdom in that paper as well, which I can't wait to get to. But first, how about we start with just a little bit of background on yourself? I think most people know who you are, but it might give us a little bit of context around our discussion today. So, can you give us a bit of background on yourself in regards to trading?
With regards to trading, sure. I began trading on my own because it interested me in the mid to late 90s. And then I began trading full time for myself. And I started a small fund in 2001. And so I've traded full time since then. I also run quantifiable hedges. I started doing that in 2008, and that's, if people aren't familiar, it's a website and blog where I share just a lot of my market studies that I do, and I have a newsletter that discusses my outlook on the market based on my studies, pretty much. So I've been trading full-time since 2001. In 2019, I closed the fund I started. It was primarily friends and family. It was, pretty small. Didn't want to deal with regulators or state agencies and things like that. So I kept with the original rules, and the fund remained fairly small over time. But in 2019, I decided to join Capital Advisors 360. And a friend of mine there, Jeff Peach, he had opened the shop as East Sound Capital Advisors in 2011, and he ran it. It's a registered investment advisor in the U.S. So I took a lot of my strategies that I used with the fund and with my own trading, and brought them over there, and it created a lot more flexibility for me. It allowed me to work with different kinds of people, and it allowed me to do a number of different things. Jeff used to joke with me, because I had the unregistered fund. He would say, "When are you going to go legit?" Which meant get registered and do everything the right way. So I went legit about 5 years ago or so. And so I do that now. I do Capital Advisors 360, where I do advising and money management for people, and then I also still do quantifiable hedges. I still enjoy that. It's kind of my baby.
Yeah. All right. Well, thanks for that, Rob. I want to just, ask a little bit more context around this paper of yours. The title was Chicken and Egg. Should you use the VIX to time the SPX or use the SPX to time the VIX? What inspired you to write this paper?
Well, a lot of what I've always read over time was people would use the VIX as an indicator for anticipating market movement, right? So, and when the VIX first came out in the mid 90s, that made sense. You could only use it as an indicator, right? It wasn't something that was tradable. It became somewhat tradable in the early 2000s. I think it was 2004 when the VIX futures first came out. And then we had options on futures a few years later. And then there was, or I'm sorry, the options aren't actually on the futures. They're on the VIX index, but they're tied to the futures the way they trade. And then the VIX ETNs started coming out in 2010-ish, maybe 2009. Over time, there's been a movement where you can trade the S&P and use the VIX, like has been done many times, or you can trade the VIX as well. And so what works better as an indicator for the other one was kind of what the paper was looking at. But really, I looked at it, from the standpoint of, does the S&P time itself better than the VIX? Does the VIX time itself better than the S&P? And we looked at it a few different ways in there.
Yeah. Well, don't give the answer away yet, Rob. We're going to discuss that
right.
a little bit more very soon. I think the better system trader audience tends to be more advanced type of traders, so we don't really get a lot of complete newbies here. But maybe just for a little bit of context, maybe we can spend one or 2 minutes talking about the basics of the VIX. For example, what is it, and how is it calculated?
So sure, the VIX. It stands for Volatility Index, is what it's short for, and it's from the CBOE. And basically, what it measures is implied volatility in S&P 500 options, looking out 30 days. And I think it actually uses options between 23 and 37 days, right? So it's not all just one day, 30 days from now. And it's an estimate of implied volatility is what it is.
Yeah. So I guess, in the context of what we're discussing today, I mean, you touched on this a little bit already, or you gave us a little bit of a clue, but what is the conventional wisdom about, on how to use the VIX? What's the prevailing thoughts around the application of that?
Well, the VIX tends to spike when we get into volatile markets, right? So when the S&Ps, especially during sell-offs, so the S&P will be selling off hard, and what ends up happening is the VIX spikes, implied volatility goes up. And that's why some people refer to it as the fear index, right? So it's kind of measuring how much fear is in the market, implied volatility being kind of a substitute for fear. The reason it does that is when the market's selling off hard, people are more inclined to protect their portfolios, right? And one way to do that is with options, and S&P options are a popular way to do it. So if you're looking to purchase portfolio protection, you're going to be more willing to purchase that protection and willing to pay more when the market is selling off, right? That's when you're basically worried about it. When the market's just kind of meandering sideways to higher for long periods of time, people tend to not be willing to pay as much for protection, and they may sometimes ignore protection altogether. So that's why
I think actually we've got. Oh, sorry, Rob, I cut you off there. Go on.
No, that's right. So that's why the VIX tends to get low when we're in a rising market environment.
Yeah, I think we actually have an image of that, don't we? Here, let me. This is coming from your paper.
Okay.
Here we go. VIX. Yeah, the VIX spikes here. So.
Yeah. So this is just a picture of the VIX. So you can see it's traded between just under 10 to just over 80. Rarely gets above 80. It's normally between, say, 12 and 25-ish. And you'll get spikes up over 30 sometimes, and 40 and 50. But the yellow shaded areas are times when the S&P 500 had a drawdown of at least 20%. And the yellow shading ends when that drawdown or when the sell-off ends and it starts recovering. So what we see is the big VIX spikes tend to happen when there is a bear market or market or a crash or something like that. That one in 2010 there, I think, was associated with the flash crash. That's not highlighted in yellow, right? That spiked up to a little over 40. So that was a more of a short-term event.
Yeah. So do you think then that do traders typically use this as like a hedging technique, or do they trade it as like a strategy, or what do you think is the common way to apply this?
Yeah, well, originally it could only be used as a measurement of, how much people are paying for S&P 500 options, because that's really what it is. It's just a measurement of that. But then they put futures around it. So they said, well, you can trade futures based on what you think the index will, be at the end of, periodically during the futures expiration each month, right? So then people could trade the VIX more directly. And so you can use it multiple ways, right? You can use it as an indicator for fear in the market. You can say, hey, the VIX is spiking, or maybe there's complacency if the VIX is real low, and that tells you options are cheap. But rather than just go ahead and buy S&P options or sell out S&P options, you can actually go in and buy VIX futures. And some people will do that instead of buying options.
Right.
So
okay.
Right. It can be a substitute, because the VIX futures will spike at the same time the S&P sells off hard generally.
Right. Okay. So these spikes in the VIX then are really just, I guess, about uncertainty, and not necessarily that it's like a bear market. Is that right?
Yeah, and it's partly uncertainty, but it's partly how the market's acting now as well, right? I think you got another chart that looks at implied volatility. Did you?
Yeah. This one?
Okay.
Yep.
Yeah. So that's interesting in the fact that when people are estimating, and really that's what the VIX is, right? It's an estimate of what volatility is going to be over the next 30 days. And you think, well, what's the easiest way to estimate what volatility is going to be over the next 30 days? And one way is to say, well, what was it over the last 30 days? And that's what you're seeing here. The VIX is in red there, and the historical volatility over the last 21 days, which is equal to about 30 calendar days, is shown in blue. And so most of the time you've got the VIX slightly above realized volatility or historical volatility, right? And that makes sense, right? Because, well, we know what it was over the last 21 days. We can estimate it'll be about, or over the last 30 days, we estimate it'll be about that over the next month. But there's no guarantee that it will, so we're gonna make it a little bit higher when we're charging, right? So that's what you see here. It lines up with the size of the actual moves in the market, and so if you get into a volatile market environment, that's when the VIX is going to get high, because if the S&P is moving back and forth 2% a day, that would be a VIX of about 32. If the S&P is moving back and forth 3% a day, you're looking at a VIX of about 48. So that's using, it's called the rule of 16. It takes implied volatility on an annual daily basis and annualizes it. Anyways, a 1% move in the S&P is about a 16 VIX. Okay, so 5% move is like an 80, right? So it takes a lot of actual movement to keep a VIX at an elevated level for an extended period of time, right? So even if the market stops selling off, if it goes sideways or if it starts selling off slower, and real volatility comes in, you're probably going to see implied volatility start coming in as well.
Right. Okay. So what does that mean then? That gap there between realized and implied, from a behavioral perspective?
Well, like
The traders
like I said,
overreacting, or
they're not necessarily overreacting, but you can't. If your best estimate is last month for the next month, you got to give yourself some cushion in there, right? So you can generally, if you're selling volatility, sell it for a little more than that. If you're buying volatility, you're willing to buy it for a little more than that, right? It's like insurance, right?
Yep.
We know how much it costs to, keep the car going, and insure against accidents or whatever, or health insurance, how much keeps to keep you going each year. But there's going to be a premium above what the actual expected level is, and so that's what you're seeing with S&P options reflected in the VIX.
Yeah. So I just want to go back and touch on the point you made. So just to clarify, you don't necessarily get a higher VIX reading in a bear market. Is that correct?
No, you
Can you
won't
have a low
necessarily.
VIX reading in a bear market?
You don't often, because when you get into bear market
Right.
environments, you tend to get more volatile movement, right? But it doesn't necessarily have to end with a big spike in the VIX. So take 2022, for instance. That wasn't a scary bear market in the sense of there was all kinds of, it wasn't like 2008 where the world financial system's about to melt down. It wasn't like 2020 where, we got a zombie apocalypse and no one can leave their house and the economies are shutting down, right? Like,
yeah.
What's the world going to look like in 6 months? Half of us might be dead, is what we were being told early March that year, right?
Yeah.
2022, the market sold off because interest rates rose. Now, if you got to choose between a zombie apocalypse and a rise in interest rates, which is going to scare you more, right? So you didn't get a huge spike that year, and you also didn't get the kind of actual volatile trading that you got in things like the Great Financial Crisis or the COVID crash or some other events.
Yeah. So just looking in your paper, and you've got a really nice chart here of the interaction, I guess, between SPX and VIX. So can we talk about this a little bit? Because I think it's a pretty important observation. So what are we looking at here?
Yeah, so and this is something that most people that follow the VIX even a little bit understand, and that's that they tend to trade opposite each other, right? So they're inversely correlated. So as the S&P moves down, the VIX will generally move up. Or if the S&P is moving up, the VIX will generally move down. And it's not a perfect correlation, and there's timing issues and other things, but you can see clearly, and you can choose any time period really, and you'll note that when there's moves up in the S&P, there's often moves down in the VIX, and vice versa. So that's basically what that chart's showing.
Yep. So back to the prevailing wisdom on this, you're using the VIX to I guess position in the stock market, right? SPX.
Right. So prevailing wisdom is, hey, the VIX is really overbought. It's probably going to come down. Let's use the S&P. Let's buy the S&P. Or the VIX is really oversold. That means the market's susceptible, and let's short the market because we're probably going to get a spike in the VIX. Is what the conventional thinking is normally.
Yep. Now, part of the discussion or reason we're talking about this today is that you've challenged this conventional wisdom a little bit and observed some other things in your research. And I noticed in your paper that you split it up between long-term and short-term. So maybe do you want to talk a little bit about, long-term market indicators first, like the VIX versus the SPX readings? What have you, discovered in your research?
Yeah, well, that wasn't a great discovery. I almost left the long-term part out, but
I'm setting you up for the short term next. That's all.
okay. So basically what I did is I looked at it as a long-term market timing indicator.
Yeah.
And I went back to the inception of the VIX and said, well, if we use the S&P and I looked at like the 200-day moving average, I looked at Golden Cross, I think I looked at whether it was up or down over the last year, just kind of a long-term market filter. Could you enhance returns using simple long-term market filters like that? And the answer was yes, right? So if you're using a 200-day moving average on the S&P 500, you'll avoid the worst bear markets or a big chunk of the worst bear markets, right? And same thing with the Golden Cross, and same thing with a lot of these other long-term market indicators. So what I did is I said, well, the VIX and the S&P trade inversely. Let's see if those same long-term market indicators do well with the VIX. And so I took the same ones, the Golden Cross, a 200-day moving average. But I did like a 200-day moving average of the VIX and said, well, since the VIX trades inversely, if we're above the 200, that's a time to get out of the S&P. As it turned out, the long-term indicators for the S&P were solid. Trying to use the VIX as a long-term indicator was garbage. It didn't really help at all. In fact, it hurt performance versus just simple buy and hold, which is probably why you don't see a lot of research on using the VIX as a long-term indicator.
Yeah. Why do you think that is? Or why do you think it doesn't work long-term?
Well, I think partially because of volatility of it, right? Because you can get a spike above that 200-day pretty quickly. There's also not a natural long-term move in the VIX. Like the S&P went from 100 to 1,000 to now it's at 5,000, right? It goes up over time. The VIX over time is going to stay in generally the same range, right? So it's always going to be high when it hits 40. It's always going to be low when it hits 10. Applying a moving average to something that's moving sideways is just going to chop you up.
Yeah.
Right.
Yeah.
I'm sure you've seen that with plenty of other systems.
Yeah. Okay. So what about then short term? If long term doesn't seem to work very well, what about short term indicators comparing VIX and SPX readings?
Well, short term indicators of VIX can be useful, right? And so people have taken the conventional wisdom and designed some strategies and some models that look pretty good. And what I did is I took some simple indicators. I used multi-day highs and lows for one. So I said, if you get a 10-day high or a 10-day low, and I did 5 and 15 and 20, I think. And then I used a short-term RSI. And I looked at 2-period, 3-period, and 4-period RSIs. So what I did is I said, all right, well, if the VIX is overbought, so short-term RSI is high, or it's hitting a new 10-day high or something, what does that mean for S&P action the next day? And then I did the opposite, right? If it's oversold, what does that mean for S&P action, right? So an overbought VIX hitting a 10-day high, VIX with a really high, RSI 2, something like that, means that there's been a spike in fear and the selling's probably overdone and you're probably going to get bounced. And that's what many of the conventional wisdom type systems say, and it does work. But if you take the same indicators and you just apply them to the S&P, and you say, all right, what if the S&P is oversold based on RSI? Or what if the S&P is at a 10-day low? 10-day low for the S&P is similar to a 10-day high for the VIX. So I compared the two. What I ended up finding is that just using the S&P to time itself actually works better than using the VIX to time the S&P. So a 10-day low in the S&P is more suggestive of a bounce than a 10-day high in the VIX is. A 20-day low in the S&P is more suggestive of a bounce than a 20-day high in the VIX. And it was especially so when you look at the inverse of that, right? So when the S&P's overbought, the chance of a decline is decent. When the VIX is oversold, it really doesn't tell you much. It can stay oversold longer than the S&P can stay overbought for whatever reason.
Right. Okay. So that's a pretty neat observation, and obviously against what the conventional wisdom is. Can you describe a little bit about the process you came up with that, just so that we know you didn't just make it up along the way? Because I think it's in your paper, it goes through all the details of how you come up with that, and it's brilliant. But maybe if you can just give us a little bit of a taste of how you came to that conclusion.
Yeah, sure. So, I used testing software. I did most of it with AmiBroker, in case anyone cares. But basically what I did is I said, anytime there is a 10-day high in the VIX, we're going to go long the S&P and hold it for 1 day. And then I said, anytime there's a 10-day low, we're going to go long the S&P and hold it for a day. And then anytime you're in between, we're going to go long the S&P and hold it for a day. So I bucketed every different type of instance.
Yep.
And saw where the best performance was for the next day. And then with RSI, I bucketed it basically, 0 to 20, 20 to 40, 40 to 60, 60 to 80, 80 to 100, right? So I did quintiles there. And what we found is that, the most oversold, for the VIX, the most overbought quintiles showed the best S&P performance. And same thing for the S&P. If the S&P is oversold, the lowest quintiles showed the best next day performance. So the more oversold you were, the more likely you were to have a good day the next day. And so that's how I kind of got a direct comparison between the two.
Yeah.
And what's interesting is maybe it was for RSI 3. There was one where the buckets were almost exactly the same size. The number of instances where the VIX was overbought was almost exactly the same as number of instances where the S&P was oversold, right? And the S&P ones still, did a better job of predicting the S&P performance than the VIX ones did.
Yeah. So if we were to summarize that, really make it simple, would you say that S&P readings are more robust than VIX readings?
For measuring short-term S&P movement, yeah.
Yeah. Okay.
Yeah. So
that's kind of opposite to what people think. Yeah.
Yeah. Yeah. Yeah. People use the VIX because they think they're looking at something different, but the different thing doesn't really work as well.
Yeah, that's interesting. Yeah. So the example you just gave there, you've been talking about RSI and some very short time frames like 2 and 3. Is that like the best type of indicator to use in these applications, or are there other
you can
maybe like a stochastic or something?
Yeah, you can use any short-term indicators that you want. I used a couple that were simple and made sense and had nice delineation, right? So one of the advantages of using short-term RSIs is you get readings that are, between 0 and 20 and between 80 and 100 fairly often. If I used a 14-day RSI, everything's going to be stuck between, 40 and 80 or 30 and 70 or whatever it is, right? So you're not going to get enough delineation to, I guess you could say, it's the highest in a year or whatever that you can, but I wanted to keep everything as simple as possible. So by using the short-term RSIs, you get that. And they short-term readings tend to be a better predictor of short-term movement than long-term readings are anyway.
Yep. Okay. All right. So we've got this observation now that rather than using VIX to time the S&P, we do it the other way. We can see edges in the S&P. Sorry, we can see readings in the S&P can be used to, I guess, to trade the VIX. Now, what about the practical side of this? Because the VIX can't be traded directly, or maybe even before that, we should talk about volatility-based instruments. Can you talk a little bit about what are some of the options and the characteristics of those particular instruments?
Sure. I guess the place to start is with VIX futures, right? Because everything's based off of them. So, and they're pretty simple, and they work like any other futures contract. They expire once a month. The expiration date is typically on a Wednesday morning. We're in June now, so it won't be Wednesday morning because the U.S. market is closed for Juneteenth this Wednesday in June. So it's going to be a Tuesday morning. So that'll be a little unusual. But the futures can be traded quite easily. They go up to 8 or 9 months out most of the time. All right, so you can trade next month, the month after that, month after that, and there's you can see what the term structure looks like at the CBOE website, or a lot of times I'll look at VIXCentral.com, and it just it shows you where the VIX futures prices are as of today, and you can look back historically as well and see what they look like. But when you get to that expiration date, the futures is going to match the VIX, right? So most of the time, the futures are above the VIX, right? When the VIX spikes, it will sometimes spike above the futures. All right, and then and that's just people. It makes sense because most of the time people are worried about the VIX spiking, right? So if you're in a market environment like now where the VIX closed today at 14-ish, are you going to bet that the VIX is going to close at 14 in 2 months? That's kind of low. So the VIX futures in 2 months, I don't have it in front of me, but they're probably 16 or something. Now the futures, there's also options on. I'm sorry, that's inaccurate. The options are on the VIX itself, but they settle at the exact same time as the futures. So they tend to trade in conjunction with the futures. So there's no arbitrage. Okay, so they settle at the same time as futures, so they're going to trade basically alongside them. And they can be traded like the futures for most hours of the evening. And you can do, complex option strategies with them if you want. You do spreads and strangles and straddles and butterflies and whatever you want. Then there is the exchange traded notes or exchange traded funds. And they're the most common that people trade. They tend to hold a constant maturity. So for instance, VXX is kind of the longest running, most popular, and that trades long VIX futures, but it maintains a constant maturity of about 30 days. So to get that constant maturity, it needs to have some front month futures and some second month futures. So what ends up happening with these ETFs and ETNs is that based on the futures term structure, there's going to be either a wind at their back or in their face. And for long VIX futures like, long VIX ETNs like VXX, when the futures are in Contango, which means the second month is higher than the first month, that's a headwind. And they're in Contango about 86% of the time historically. So there's normally a headwind for these exchange traded products. And that's why you see, they've gone from upper left to lower right on the chart pretty consistently for a long period of time. And by pretty consistently, take a look. There you go.
Here we go.
So this is UVXY. This is a chart from the paper too. UVXY used to trade at 2 times leverage to like VXX. After the Volmageddon or Vixplosion in 2018, they dialed it back to 1.5 times. But if you can't read the numbers on the chart, on a split adjusted basis, it's gone from about 22 billion down to, I don't know, what does it say there, 7 or 8? So, yeah. So from 22 billion down to 8, I see a trend.
A little, yeah.
Yeah. So the idea is there's probably some way to take advantage of that. It's more than just the fact that the market went up over time that's pressuring UVXY and other such ETNs. Now, what's interesting is that this also holds true for the futures. So if you have a continuous futures contract, it's not as extreme, but the front run futures now are at, I don't know, they're 14 something or around there. And if you look back to 2007 on a continuous basis, that same the futures would be at mid 200s or so. So they've come down quite a bit over the years, and the chart is pretty steady as well.
Yeah, I think what's interesting about this is when you overlay it on a S&P chart, and I know you've got a image of this in your paper, which I'm just trying to pull up now. Here we go. So there's
that's yeah.
What am I looking for here? This one.
Yeah.
Yeah. What are we looking at here?
This is the bear market from 2022. And what I show is, from the beginning of it till the end of it, right? So it went down through October of 2022, and it took until the end of 2023 or maybe the first week of 2024 to fully get back and make new highs. If you look at VIX futures, it didn't take nearly as long to make new lows. And you look at basically any bear market, and you're going to see this play out. The fact that the VIX is going to make new lows well ahead of the time that the S&P gets back to new highs. You don't really need the market to reach new highs for things to calm down, right? Like you just need the panic to stop for things to calm down. So in 2022, this was kind of an extreme example. It took from January till maybe August, so maybe 6 months until it was making new lows again. And the S&P hadn't even hit its ultimate low at that point. When the S&P hit its ultimate low, from there for the VIX to make another new low was what, like a month and a half, 2 months maybe. So the recovery has been fast for the VIX. Now you can get really strong spikes. You can't say, well, I'm going to go 100% short the VIX, right? Because it can go well over 100% against you. But if you're position sizing conservatively, and you understand, where your risks are, a short and hold in the VIX has much shorter drawdown periods than a buy and hold in the S&P.
That's really interesting, that observation that the VIX recovers faster than the S&P. Traders can leverage that, I guess, to smooth out their equity curves, right? Reduce drawdowns or the length of the drawdown. Really, am I taking the words out of your mouth here?
Yeah, you're dead
That's
on,
the
right?
yeah.
Like that's what I love about it so much is like I don't expect my drawdown period to be very long with many of my VIX models.
Yeah, yeah. I think actually in your paper, I'm just looking through now. I think you've got an example of a, I guess it's not a complete strategy, like a model kind of strategy where you use. Sorry, I'm just trying to find it now. My screen here, where you use SPX signals on the VIX.
Yep.
Can you talk a little bit about this one?
Yeah. So in the paper, we looked at RSI 2 and found that when the S&P's 2-day RSI is low, that tends to be a good time to be short VIX futures, and when the RSI of the S&P is high, that tends to be a decent time to actually go long VIX futures. So this is a simple, demonstration model of that, and this is doing exactly that. When the RSI 2 of the S&P is below 30, we're going to go short VX, which is VIX futures, and when it's above 90, we're going to go long VIX futures, and we're going to hold it till that's no longer the case, right? So this shows the long-term curve and shows what the profits in in the actual numbers of the VIX readings. So you would have gained 225 VIX points basically over that time period. And the drawdowns weren't long, but a couple were sharp, right? COVID crash especially.
Yeah, I love this example because it really shows, I guess, the crux of your paper, that you can use SPX signals to trade the VIX rather than the other way around. And just looking at a chart there, anyone can see that there's some type of edge. It's heading in the right direction. Now, earlier you were talking about VIX term structure, something you might want to consider. This isn't obviously a complete strategy. It's just a model demonstrating an edge. What other factors do you think traders need to consider when they're going to apply something like this?
Well, yeah, term structure is another thing that, especially if you're trading the ETFs, you'll want to take into account. Risk management. There's no risk management in that strategy. So, you can just trade one contract and you'll know that, the worst it was over time was, I don't know, was it 25-point drawdown or something there? But you probably want to put risk management in your and position sizing and everything that you would want to put into a real live tradable model. You're going to want to put into a VIX model, and with the understanding that while drawdowns might not last as long, you got to be able to sit through them, right? You can't you don't want to get blown up. And so if you get over leveraged, you're going to get blown up, right? With any strategy, right? But and kind of the point of showing that model wasn't that like, hey, this is a great model. It was more, let's look at and see the consistency of the tables I showed over time, right? Because I can tell you that since 2010, the VIX would have dropped 70% of the time that the S&P was hitting a 25-day high. But that 70% of the time might have been the first 70%. It might have dropped every time, like the last 30%. So it's always helpful looking at a profit curve when you want to look at the consistency of any kind of edge.
Yeah. We got a question here in the chat from Lawrence. Let me put this up on the screen. It's about assessing the robustness of VIX strategies. Do you use metrics such as edge ratio, or how do you, what metrics do you use to determine the robustness of strategies?
Well, a lot of times I don't use edge ratio myself. when looking at the robustness of strategies, I will run it under many different levels. So like if I'm saying, does this work for RSI2 less than 20? Well, we also want to see, does it work for RSI2 less than 15? Does it work for RSI2 less than 25? Does it work for RSI3? Does it work for RSI4? So we want to, I want to have it look at many different measurements. And for me, a lot of the times I don't use one measurement, right? If it works for, I'm not trying to find the best measurement historically. I'm trying to find a robust group of measurements or of indicators that work, that demonstrate, what the edge is, and then I'll select several of them to use in a model. So that'll help you, determine your, how much you want to be long or short, and your position sizing, and just how aggressive you want to be. It also keeps you from that single point of failure, right? Where, hey, it used to be that 20 was the best measurement, and now 25 is, and now 30 is, and now it's back to 20. Well, if they all seem to give some kind of edge, it's going to change over time what the best one is. So use several of them.
Yeah. I really like how you do that. Oh, sorry, Rob.
I said you won't be completely wrong that way. But you're probably partially wrong.
Yeah, that's. I recommend people go and download the paper. I'll put a link in the description. It's on SSRN, and you can also get it from the NAME website. But I really like how you kind of slice up those levels into buckets, and then you also have different variables. Different lengths of the indicators, and you're really just observing a behavior first, and then building a strategy on a behavior is quite robust. So I think the question of using a metric to determine the robustness, it's almost like you've determined it before you even get to the strategy step, right?
Yes, and that's what most of my back testing is aimed at. It's not at finding the best indicators or the best readings. It's at what can we learn about the market, right? Like, how does the market behave when we're overbought or oversold, or volatility is high or low, or things like that. So I go about testing most of the time and trying to learn something about the market rather than I got to build a model off this.
Yeah. All right. Thanks for the question, Lawrence. We got a question here from Zoran. Zoran's a regular here. G'day, Zoran. Does VIX get manipulated from time to time, and can that be detected easily?
I don't know if well, the VIX can't necessarily get directly manipulated. I guess VIX futures could, or option prices. So yeah, it's not something I really concern myself with. Is the market overall manipulated? Sure. Like, people say the market's not rigged, but yeah, I mean, it's been rigged since it started. Like, we're just trying to figure out, who's rigging it and how, get on their side. I mean, that's what technical analysis is, right? It's trying to identify where buying and selling is occurring. And quantitative analysis is trying to measure that a little bit more. So does manipulation occur? Maybe. But with the VIX index itself, it's just a measure of S&P options. So it would be hard to manipulate the actual index.
Yeah.
The open can be manipulated. And you do see, like the VIX will decline heading into the close on Fridays, and it will spike up on Monday mornings. But that's not manipulation. That's just people adjusting their option pricing for the weekend when the market's closed. So it's just
Yep.
it's a behavior you need to keep in mind.
Yep. Have you applied this research in other markets, for example, VIX and commodities or crypto? Have you looked into that at all?
I haven't.
Okay.
No, I haven't used. I don't really trade crypto. I'm sorry. I think I just heard half your audience leave.
There is actually a crypto question in the chat from Lucky, so I guess we can get that one. There you go, Lucky. He doesn't trade crypto.
But I don't really trade commodities a whole lot either. I have
Right.
in the past, and I do some, but I haven't looked at like the VIX on commodities. No, the reason I don't even use VIX for the NASDAQ, and the reason is there's no futures, there's no tradable instruments off of it, right? So I trade the VIX instruments. I trade the ETNs, I trade the options, and I trade the futures.
Yeah.
So if I can't trade it, don't care as much.
Yep. Yeah, that's a good point. Thanks, Rob. We got a question here from Chris. This is two-parter, so I'll read both parts. How do you size your positions? My struggle is I have a few different systems, but sometimes too many signals. What do you do, or how do you mitigate too many signals for the cash in your portfolio? Part two, because you don't know in advance how many signals you will get. Any help would be great.
So my systems take that into account. So, like if we're talking about, say, a model that trades S&P 100 stocks, I will take, say, up to 10 positions. If I am long 5 positions and I have 15 potential stocks that'll be triggering tomorrow, I get those 15 get ranked so that I'm only taking the top 5. So I only put out trades for enough that would fill my portfolio. I don't look to trade all 15. I just take the best ones, right? And you can rank the best ones however you want. You want to trade the most volatile stocks, you want to trade the least volatile stocks, whatever it is, you can. That's something that can be tested.
Yep. All right, thanks, Rob. Well, we're coming up to closing time, so you've covered a lot of good points today. How would you summarize our discussion or your observations in your paper in, 3 to 5 points? What do you think are the main key takeaways for people today?
Well, I would say that there's a real inherent edge in trading VIX instruments, and that it would behoove traders to understand that and maybe consider trading VIX instruments. They need to manage the risk. They need to find ways that that there's a real edge to trade them, not just let's short and pray, but and the paper gives you a real good start, I think, with let's see if the S&P is overbought or oversold, and that'll give us a pretty good indication of what the VIX is likely to do over the next few days. Or what the VIX futures or what the VIX ETNs, and you'll want to measure whatever instrument you want to trade. I did mostly futures in the paper because it's the simplest. But look at all that. Look at all the risks of trading it. And I think I've made more trading profits trading VIX than anything else. It's my favorite. It's my favorite thing to trade. whether you're looking at the futures, the options, or the ETNs. And like I said, I trade all three for different reasons.
Yeah. That's a good summary. Thanks, Rob. I've got a couple of key points here. I don't know if you're interested in hearing these, but these might these are the ones I got when I went through the paper. There's 4 points here. So SPX movements are more reliable for predicting VIX movements than the reverse.
Yes.
Market timing for S&P, use the SPX instead of the VIX. VIX has a quicker recovery than the SPX, so it's a great way to reduce the length of drawdowns. And then my final point was SPX indicators, particularly overbought and oversold measures, they have a much higher predictive value for VIX movements than previously recognized, I guess, is probably the way to say that. So how did I go? Did I pass?
Yeah, you did better than I did.
Okay, good. As I was reading that, I was like, I hope I got this the right way around. Otherwise, I'm going to look like a goose. Anyway, so so that's a great paper, Rob. Thank you very much for coming to discuss it today. Now, if people want to learn more from you or get in touch with you, how can they get in contact with you? Where's the best place to go?
Well, you can reach me at on email at support@quantifiableedges.com. You can get me on Twitter. You got that there.
Got that there, yeah.
Or X now, right? Quantifiable edges kind of smushed together. And I guess those are two of the best places to reach me. All right, so just email or Twitter. And or you can look up my contact info at Quantifiable Edges.
Yep. Now, also you have a VIX trading course which I've been through, and it's really, really very good, Rob. So well done on that. And you've had made a very kind offer for Better System Trader listeners. If they want to jump into that, there's a coupon code. They can get a discount for the next for next short time. So if people are interested in finding out about that, you can head over to this page here, bettersystemtrader.com/VIX. Put your email in and I'll send you the special coupon code for Better System Trader listeners only. So thank you very much for that, Rob. That was very generous of you to help out the trading community.
Sure. I'm glad you didn't ask me what the code is because I don't know.
I don't remember either. It's on the page. So head over to there, bettersystemtrader.com/VIX. Well, thanks a lot for your time today, Rob. It's been great catching up with you again. I'll catch you again in 9 years, maybe. I don't know. But any closing thoughts before we wrap up?
No, I really appreciate you having me on again. It's always a joy getting to talk to you. And frankly, I listen to your show quite a bit too. So,
good.
Yeah,
thank you.
You've got great guests, and you get them engaged very well. You even got me talking here. So,
it does help to have good guests like yourself, Rob. You make my job very easy. So, thank you for joining us today. And we got some thank yous in the chat here as well. I'm sure people will have found value in what we're discussing. And I'll put links in the show notes in the description for access to the SSRN paper if you can't find it, plus contact details for Rob. So go and check that out. And thanks for your time today, Rob. I really appreciate it. And all the best.
All right. Thank you.
Cheers. Thank you. Bye.
Bye-bye.